So, okay. Hey everyone, this is Ashish. We are joined here by Julie. She is on mute. We are waiting for a few people to join. We have a big crowd, so we'll give them next few minutes to join. I hope everyone is doing well. We are talking about tax planning for wholesalers today. It's going to be a good informative session. So we will wait for a few more minutes. While we are waiting, if you guys want to tell us where you are joining from, in the chat, it really helps us understand where you guys are coming from. Okay, lot of noise. If you guys cannot hear me, please let me know. We have some, I think we just got the power back. I live in Florida. We had a hurricane and there's a lot of internet issues and power issues. If there's some disturbance, please let us know. But we'll give few more minutes for people to join and we'll start in maybe next 2 or 3 minutes, okay? If you can, let me see if you can tell us where you guys are joining from. It really helps us understand where everyone is coming. In the chat, you can write all your questions through the chat. You can see, I think Julie has posted to host and panelists. So I'm gonna, guys, before we get started, I'll just do this housekeeping work. I'm sending this link for everyone, and so that you guys can connect with us after the webinar. Okay, there's a form, there's an email you guys can send us. I just want to get that done before we can move on to the bigger, better stuff. The form, you just fill out the form and so we can help you. Email you. If you guys do not know how to contact us, you can just go to investorfriendlycpa.com and you can just contact us from there or email us. Email me, Ashish at investorfriendlycpa, info at investorfriendlycpa, Julie as investorfriendlycpa, so we can help you. We still have people joining us. I see some hand raises, guys. If you have questions, please list them out on the chat so we can answer them as we go. We'll get started today with a few things. The goal of this call and the webinar is to have everyone understand. You guys need to understand wholesalers. And when I say wholesalers, just everyone knows, this applies to any other business too. We'll talk specific about real estate. However, this also applies for any kind of related businesses. Wholesaling is like, it's a non-passive business. If you were to go and open up a food truck, it's a restaurant, on same kind of income, similar characteristics, right? It's a non-passive income. You can do this. Most of the things I talk about today, you can also do so for other businesses too. So if you have a family, friends, spouses doing other things, you can also use this to save taxes at every level in your household and any other businesses you're involved. The concept is they're similar in nature. Wholesalers have specific needs and entity structuring and LLCs. We're going to focus on those kind of stuff today. But in general, the concept we discuss is usually applicable in other businesses too. So make sure you guys are looking at that as well. See. So we're gonna get started. I'm going to see what is gonna happen. Okay, I think we have enough big crowd to get started, guys. Just to a quick recap, please write down your questions on your chat. I think everyone can do so. I just posted one chat there. Let me see if maybe chat is disabled. That's what they're saying. I cannot. Julie does that. So chat previews. And fine. Q&A answered one. Chat is disabled. I guess you can ask questions in the Q&A. And not in the chat, I guess, because I see Dominic's question there, and you can basically answer everything on. Maybe there's something changed on Zoom. You were able to just do this on chat, but now I guess it's Q&A. Can we just answer everything? Like ask questions in Q&A, and we can reply right there. Because I don't want to spend time trying to figure out the chat, what happened, what Zoom did with the chat, because they tend to change stuff every single day. So you can put all your information on the question and answer at the bottom of your screen. And like Dom has asked, he said chat is disabled in the same way. So today we're going to focus on two big areas. I think I'm going to start with your entity structuring, how wholesalers should think about entity structuring in their own wholesaling business. And also, if you're going to buy real estate, other businesses, how this wholesaling and how your entity structure in wholesaling also affects other businesses and how you should keep separate or combine them. We're going to talk about that first. And then we'll run some numbers. If you're making a certain amount of income at a wholesaling business, what could you possibly do to save taxes is what we're going to talk about next. Those are two things we're going to focus mostly. It's going to be a very fast-paced webinar. So please make sure, you can always rewatch this. We share this on our platforms. You can always rewatch this and you should be fine. I'm going to share my screen next, okay? Okay, so let's talk about it. First thing we're going to talk about is your entity structuring. Wholesalers, they tend to make good money, but you need to understand how to save taxes in that money. This is our tax planning module. We do go to a bunch of stuff. One of your entity structuring. Let's talk about this one aspect. We're not going to do everything, so it would be impossible. I just want to talk about this aspect of your business. We talk about this a lot. I'm not going to go over how to hold your investment with the trust and holding LLC. There's a video on our YouTube. You can always watch that if you need to. Only thing I'm going to focus on next is how you should think about your wholesaling business compared to other businesses. In general, as an investor, there are three things you can do. Okay, if you look at this, on rental side, you have your own rentals, you have rental with your partners and partnership with others. Sometimes you invest in syndications. And you have this is where the wholesaling comes into play. One thing most people miss, and the biggest thing I want to take away from this next few minutes is, the reason is eventually your wholesaling will be reported on. As corporations are, way to save you some self-employment tax, it files a separate tax return. But if you keep them under rental real estate or anything anything that hosts rental, you screw up things. Rental in the S corps are one of the worst thing you can do. If you need it, and understand, we have two YouTube videos explains why we should not have S corp owning the real estate. What's that if you need to, but keep them separate. That's the first thing I want you to understand. And second thing, most of the wholesaler miss is one of the worst thing they can do is this. They will create an S corporation, let's say, and they will partner up with someone else to find properties, join hands, and divide up the fees. When you do that, what happens is you have created a partnership. On my screen, if you see anything that's red, it says need tax return. When two people, including you and someone else, comes together and does the wholesaling together for one property, it's a partnership. You have to file a tax return separately. So if you do that with 10 people, that's a 10 partnership. That's 10 partnership tax return. If it costs you $2,000 to file one tax return, there's $10,000 you just lost. Don't do that. How you structure your wholesaling with other candidates. This is someone brings up the deal for you and you divide it up. Don't act like a partnership. Don't sign a contract saying this is a partnership. You can just give them 1099 income as an agent fees, commission. Do not base this on a profit. This is one of the biggest thing people miss. So when under the entity structuring, one of the two biggest thing is what I just said. First thing is you have to make sure you get an S corporation and how it interacts with other. You need to understand that first. Second is do not go ahead and start creating partnership with your other connections when you are doing wholesaling a deal. That will really hurt you by having to, when they find a deal and you give them a partner, you open up a partnership, you would file a partnership return. So one of the question is, so we wouldn't want to sign a joint venture agreement, correct? Joint venture by definition is a partnership. If you put that word anywhere, you have to file a tax return like this. So don't do that. People do this a lot, and so what is the impact of this? Is this when you eventually sell this asset, there's going to be 1099 S that goes to two partners, and sometimes IRS looks at that and they say, okay, this was owned by two people. Two people got a 1099. Did they ever file a partnership tax return? They'll look at it. They'll reach out to you saying, did you file a partnership tax return? And they'll send you notices. Not filing a partnership tax return is $250 a month by partner. So it racks up like $6,000, $7,000. And if you don't file for multiple years, it can be $15,000, $16,000. It gets huge. And people, don't understand this. The suggestion here is understand the basic concept so you can bring this up to your tax advisor and understand when you're working with them, saying, okay, this is the deal I'm doing. How do you suggest structuring it? Sometimes it's okay to suggest get an LLC and have a joint venture. If it's a big deal, you're buying an apartment, you're getting $500,000. It's okay. It's that at that point, it's a tax cost of doing business. You want the LLC because huge money is involved. If there's some kind of fraud or other partners is not ethical, you might get sued. So you do want that kind of illegalities placed into places. But if you're selling a property with a $2,000 fee, you don't want to spend that $2,000 on filing a tax return and get nothing out of the deal. Okay, so understand that first. Second thing is, like I said, S corporation. S corporation, you have to do analysis on that. Is S corp is good for everyone? No, it's not. If you're not making enough money, it might not. Depending on your household income, what your spouse is doing, what are your other jobs. If you have a double full-time job, if you're making other self-employment income, that determines if you need an S corporation. I'll walk you through those numbers in the next few minutes, what kind of threshold you should be looking at. But don't just blankly get an S corp, because S corp requires a payroll, it requires a separate tax filing, it's red, it can get expensive if you're not benefiting out of it. So there you have to do cost benefit analysis, and we help you do that. I'll help you do that in the next 2 minutes. So in general, the only thing I would want you to guys to take it out from this portion of the webinar is talk to your advisor about getting an S corporation. Depending on your income level, it might benefit you. The other thing is just don't create a bunch of JVs that what you call with other partners. If you're going to buy a rental property, you're going to buy it under separate LLCs. Look at this. It's green. It means there's no even tax return required, the way you're going to structure this. Even if you have two owners in a husband and spouse, if you layer that living trust on in between, you can get a single member LLC holding company without any tax filing obligations. Don't just create a bunch of LLCs without talking to your tax advisors. That's what it is. I answered this. So the other is the one last thing before I move on is, guys, I just told you, do not get an S corp. You're not going to go and get an S corp right when you begin your venture. No one does that. It's going to be one of the worst things you can do because you might not even benefit, and there's a lot of things it would cost you. What you'd focus on is this: you'd get a single member LLC on the top here and operate your S corporation from there. But that single member LLC should not be owned by your spouses too. Don't have your spouses own your or LLC when you're starting a wholesaling business. That again automatically creates it's a partnership. Whenever two people, including your spouse, owns the LLC together, and if you don't live in community estate, it's automatically a partnership. If you live in community estates, you have to file some elections to not file a partnership return. It's still a hassle. If possible, don't get your spouses involved directly. You can get them involved over on the top on the trust. So again, I know it's a lot of information, guys. You can go and rewatch this. I know it's complicated, but the bottom line is three things, I guess, from this. I'm going to recap and then move on to the next portion of this webinar. First is, let me unshare my screen so everyone can focus. First thing is, if you get an LLC, get a single member LLC, not a multi-member LLC with your spouse. If you're a partner, you'll always get a multi-member LLC. Non-spousal partnership exists. It's okay. But if you have a spouse and you're just starting out, don't add your partners, spouses to your LLCs. First thing, talk to you. When is S Corp good for you? We will go through that today. I'll walk you through the numbers and everything, and it gives you an idea. But in general, I do not know your specific situation. It really depends on so many variables. Talk to your advisor. Third thing is, don't start creating all these JVs unless necessary. When it's necessary is when you have a legal risk, you have bigger transaction, it's okay. If you're making $2,000, $3,000, even $10,000 from JV and doing this JV with other partners, if you're losing $2,000 just by filing tax return, it lowers it, that 20% of your income goes away. So understand the tax complications, the risk of doing that, and you should be fine. So that's all it is for now regarding your entity structuring. The good news about this S corporation, guys, is you can use this S corp, same S corp to do if you do sell house as an agent. Your spouse is an agent, you can do that. You can flip properties in the same S corporation that does wholesaling. The S corp can also do a fund manager. If you ever manage a fund eventually in the future, you sponsor a deal, you can do a lot of things. So I'm not going to go there, but I'm just letting you know, setting up an entity to begin with in the right format really helps you scale up, rather than trying to fix this later in the life, which is going to be very expensive. I hope everyone understands that. I know a lot of information. So I'm going to move into the next phase of this webinar, which is actually running numbers for you and telling you exactly what you should be thinking very high level from tax planning perspective, what makes the most impact. I think our tax, I don't know if you guys know this. If you guys do not follow us, you do not know this. This tax planning module I'm showing you on my screen is being converted to a tax planning software right now. AI-based machine learning software. I think we have like 200 tabs here. Obviously, we're not going to go through every single tax saving strategies for you guys here. And in the future, you will have, just so you know, you'll have capacity to do your own tax planning online. You don't have any products like that in the market right now. We are bringing that up probably mid next year, and then you should be able to do so. So what I'm saying right now really helps you run that in the future as well. So understand what I'm saying. It can get complicated. What I want you guys to focus on is, let's just go to a scenario where everyone is making money and how to save taxes. Very simple. Let's say we have someone lives in Colorado, because I like Colorado. I live in Florida. It can be Florida too. It's fine. You have and you're married. You're 30 years old. You don't have any kids. Let's say, or let's say you have 2 kids. Let's bring a random number there. You know what? Let's do no kids. I don't want to complicate this too much. And then let's talk about how you should be thinking. Let's say you have a spouse. Let's say I work and make $100,000, and you as a wholesaler is struggling, hustling, and trying to make a lot of money. Which you do, you go and make $150,000. This is income. Your spouse makes money. You make money, both of you make money, amazing. Now, in this scenario, I want to show you this first. Do you see, let's go ahead and see how much tax you're going to owe to the government. Right now, you're going to owe around $46,000 if you live in Colorado. Very high level. $46,000 you can owe to the government. 40, that's a lot of money, right? That's a marginal tax rate of 28%. Hold on. Am I sharing my screen? I may not be sharing my screen. Here. Okay. I'm so sorry. I do this a lot. Here. So just to recap, you guys, you guys, one of the, taxpayer lives in Colorado, you make $100,000 W2 income, and your spouse makes $150,000 from wholesaling income. And then you don't have any entities, you're just doing as a sole proprietor or Schedule C, like a normal LLC. If you do normal LLC, see what happens when you go file your taxes, what I'm showing you on my screen. Like there's a lot of numbers here, guys. Don't try to get everything. You're not. But right now, to get your marginal tax bracket, if you make $100,000, your spouse makes $150,000 from wholesaling business without any LLCs, that's a marginal tax rate 28%. Every dollar you're making, you're paying $28,000. So what can you do and what you should focus on is right now, how much you're paying? Almost $65,000. It was 47 earlier because do you see the self-employment tax? This is why you need an S corporation. And just look at what happens. When I move this $150,000 from Schedule C, which is here, to S Corp, look at that. That's gone. $18,000. It goes from 67 to 46. You're saving $18,000 just by making that switch. So what is your threshold? 150 is a very random number, I understand. It really depends on what's happening in the household, like how much income you're making. And I'll go through that calculation. Just understand S Corp. That's why I was talking about S Corporation earlier. It can make $18,000. Is that that's net of tax. If you have to go and earn $18,000, you have to earn $30,000 before tax. It's like doing 5 wholesaling deals or maybe more. So understand tax implications, entity structuring, so you can save that tax. But the goal is, let's say you have a right advisor, you get an S corporation, you save that money, you don't have to pay that, you owe $46,000 to government. Our goal is to not even pay this. You should be planning your taxes in a way that this should go away. Okay, that's what I'm going to show you next. One of the easiest way to do so is real estate, because this is the beauty of you guys. If you are doing wholesaling to some extent, you already probably qualify as something called real estate professional. Real estate professional, again, it's not a license, it's not an agent, okay? I'm talking about how involved you are in real estate. If you qualify as real estate professional, then you can pay 0 taxes if you can manage your investment. Now, how to do that is very simple. I mean, I made it simple. It's gonna look complicated. I'm going to walk you through numbers and just let me know if that makes sense to you. And this is how it works. 2024, which is this year. Okay, if this applies, you can do this even this year, guys. 2024 so we have something called bonus depreciation of 60%. And there's something called cost segregation. If you do not know this, Google it. We can talk about it. But if you do cost segregation, I just want to show you this. Do you see this threshold? It says upper threshold for a real estate purchase. That's $1.4 million. If you were to go and buy this property, the maximum you need to buy. When I say buy, you don't need to put the cash down. Okay, I'm talking about seller financing deal. You guys are a wholesaler. You can go find a really nice property, do a seller financing without any money down, go close on this property. Let's say you actually buy this 1.426257 to go and buy this property. Look at how much tax you're saving. Out of that $46,000, you're saving entire 46, almost everything. You're paying $3 to Colorado because it's not 100% accurate here. You're basically paying 0 tax. When you go file your taxes now, rather than paying $46,000 you saw earlier, you're paying $3 in tax. That's the power of real estate. Does that make sense? So let me explain this again. And if you have been in real estate world, understand cost segregation, understand how real estate investment impacts your thing, it helps you understand. You probably already understand this. If you're new, very simple. When you flip properties, when you do wholesaling properties, it does not save you any taxes. There's no way to save taxes on those properties. You make money. You can depreciate those assets. You can do 1031 exchange on your wholesaling. You can do installment sell on your wholesaling. And that's one of the things I do want to bring it up after this. Remind me, there's no seller financing for tax purpose on wholesaling deals. We'll talk about that later on. But right now, understand, first of all, you're saving that $18,000 just by getting a right entity. We talked about that before. And then if you plan you save the $18,000, put a down payment on some kind of property, you can also wipe out your income tax. Now I gave you the highest threshold. Let's say you don't want to buy $1.4 million. I understand. What happens if you buy $400,000 long-term rental? Saves you 14 grand in taxes. Still saves you a lot of money. Anything less than that still saves you a lot of taxes. But the maximum for this taxpayer who's making that money, 250, is that amount, 1.4. It changes. It also changes what kind of assets you're buying. We're talking about single family house. If you know how much you need, let's say you go and buy a tiny house. There are a lot of short-term rental tiny houses, and you meet some requirements. Look at this. Tiny house can be bonus depreciated 100%, or in even Section 179. Again, you need to work with your tax advisor to really understand this in detail. But what I'm trying to tell you is, if you already qualify as real estate professional, you can play around with assets, which works the best for you in your market, and offset 46, say $46,000 a year. That's like a full-time job for someone. That's a lot of money. And as you make more money, it gets bigger and bigger. We have people saving $300,000, $400,000 a year in taxes because of this, and you can do the same thing. Now, what is the next step? Is this? What happens at the S corp level is what I want to talk about next. Okay, there are a lot of. I know we haven't gone through with so many other things, tax and invest vehicles and individual tax level. We're not going to go over all of those guys. It's going to just take our time. We want to answer. We're going to hit the bigger stuff here. Some of the bigger stuffs are what I just said: real estate purchase. All this S corp. You need to understand how to manage your taxes. Let me go through this really quick so you guys understand. So I'm just going to change a few things around here so you understand why S corp is so important here, okay? And how you need to do an analysis of S corporation. This is how it works. If you go, let's say you make, I'm just making this up now, you make $200,000 as a spouse, and your spouse goes and does wholesaling, and you can make significant amount. I'm going to put $300,000 or $350,000. You do this. Let's go to let's do when is the right time for you to make an S corp? This was calculating, but I'm gonna walk you through this really quick. See how this works. When you get an S corporation, just by getting an S corporation is saving you 30 grand. For this taxpayer, just filing an S corp return is saving you 30 grand. Okay, this is what it is without retirement accounts. With retirement accounts, let's see how much you can save. Let's say now see, and this is what your taxpayer is gonna say to you guys as you move up. They're gonna say, oh, you get an S corp, pay you as less as possible. Don't do that. Let's say we pay you $30,000. See what happens to your tax savings. It went from 30 something to 31. It increased, right? Your retirement plan after paying yourself went to $44,000 in tax savings. If I go and increase 30 to 70, let's see what happens. But let's do 60. Actually pay you more, which is what other people will say, do exact opposite. Tax savings without even, it actually went up. By paying more salary, it went up. $49,000 from 44. So understand, again, I know this is not your situation. You might make a little, your whole situation might be different. That's why you got to work with your tax advisor to do this analysis. What I'm trying to tell you is do not get hung up with the CPAs telling you pay as less as possible. That's always not the right answer. Always make sure you understand. You need to find your optimized wages because of something called QBI deduction. Okay, it helps here. There's another aspect of QBI deduction. So understand that there's a retirement account, tax savings. Overall, you're saving $49,000 by being in S corporation when you're making $350,000 because of retirement account, because of you're paying a salary, QBI, a lot of things, self-employment income. So understand this. You need to do those kind of analysis to make sure you're getting the best out of your best out of your S corporation. Now, hiring your kids, again, paying your spouses. We go through those information here. I'm not going to go over them. It's just going to complicate things. But let's say we pay your spouse another 50 grand from your S corporation. And you go down here, tax savings went from 49 to 55. Literally, if you don't pay this is what I'm talking about. Look at this. I remove your spouse's wage. I remove your wage. You're saving $30,000 on tax. I do $60,000 to your wage, $50,000 to your spouses. That's a $55,000 tax saving. You need to do this kind of analysis. Again, it's a random number. It might go up if I just increase. So I'm not going through these numbers playing around. It's 53. It's actually went down. So that was optimized salary. So you need to come up with the optimized salary. That's what I'm trying to tell you. So always make sure you do that. Paying your spouses. C Corp, we're not going to go over this. I know there's a lot of things. Retirement accounts, you do need to do this analysis. Look at this. I know I'm saying so many things here. We just talked about paying both of you guys 60 grand each, right? Again, our software automatically does this analysis. Which one is the best retirement account for you? Simple, 401k. Look, 401k looks the best because you can do $38,000 each. That's what's saving you a lot of money. That's almost 80 grand you're doing, setting aside tax-free, which you can go and invest in real estate, guys. So if you're making $350,000, you can do that. Cost sake, I'm not going to go over cost sakes, rep status. I guess we don't have time for this. What I'm going to focus on next, even hiring your kids, you need to understand, which one is the best way. Once you hire your kids, should you be paying 1099s or W-2s? Should you open Roth or traditional IRA? It really depends on how much you're paying them. If you pay them, let's say $19,000, look at it, you're going to do traditional IRA, and then which one is better to pay? 1099, because the W-2, because tax savings is $9,000 versus $6,000, $7,000. But if you, and which is Roth versus traditional, which one it should create. This is something no one can do for you unless you work with your tax advisor. It's complicated. There's a lot of factors that go into this. So always make sure you do this. Julie wants me to slow down. Thank you, Julie. A lot of information. What I'm talking about now is when you hire your kids, depending on how much you're paying them, $5,000 versus $19,000 determines if you need to get traditional IRA or Roth IRA, or you should do W-2 versus 1099. If you pay them $5,000 for this taxpayer we just talked about, see, it doesn't really matter what you pay them. The tax savings is very similar, $1,700, $1,800, either ways. But what kind of accounts should you be opening then once you do that is Roth versus traditional IRA? Roth, because it helps them in the future. But if you pay them, let's say like $20,000, then things change. You should open up a traditional IRA with only that amount, not even full amount, and then you should do a W-2. Again, you got to do those kind of analysis with your tax advisor. Understand this. That's what I'm trying to tell you. 1034 exchanges. I'm not going to go over this. Only thing you need to understand is this is what I'm going to end my I'd say a lot of things and I answer your questions if you have not. If you don't have any questions, we're going to move on to the next phase. So come up with questions if you have one. But right now, I'm going to focus on is a lot of people miss this, and I want to clarify this. You cannot do it installment sale. So I did go over so much stuff. We have some questions here. I'm going to answer them, and then if we have time left, I'm going to go to other aspect of whatever we want to talk about this. So one of the questions we have is from when you are about to become a real estate agent, you receive your commissions and other income. What kind of taxes would you have to pay? So what you asked me is exact same kind of is very similar to your wholesaling income. If you do wholesaling income, what you get from wholesaling income is exact same thing as what you get as commission. Everything I just said applies in exact same situation. You need S corporation, you need to do everything I just said, how to structure them, same thing. It doesn't make any difference. What you file, what kind of tax you pay is what I was showing you earlier. If you don't get the right kind of entity structuring, then you're going to pay, depending on how much you make, you might pay that self-employment tax, which is 15%, right? So if you make $150,000, you would pay that $18,000 extra tax if you do not get the right entity, as we have discussed before. You have to, and depending on what kind of entity you get, you have to file tax returns, not file tax returns, depending on if you don't get an S corp. A lot of variations there. What you should be thinking is not how to file, is if you understand how to save taxes, they will help you file tax. It's a necessary evil. $18,000, $20,000 is what you should focus on. If you're not to that level of hiring a CPA, then just understand this. It's impossible for anyone to tell you if you're going to save taxes without S corporation, without actually helping you with a tax planning engagement. But I can tell you that if you're making less than $30,000, $40,000 wholesaling business or real estate agent business, you might not need to file an S corporation. You just get a single member LLC. As a schedule, you're going to file a Schedule C. You will pay 15% of that as an extra tax, but it's okay. There's no other extra cost of maintaining an S corp, filing an S corp return. You're going to balance out. Cost benefit analysis, I think it kicks in after you make $40,000, $50,000, $60,000, depending on your income tax bracket. So the answer to your question is it's the same kind of income. What can when you get real estate commissions or bonuses from your broker, it is the same income as driving Uber or working as a consultant and getting a 1099 income. Same thing. You would still get an S corp, like I said, and save those self-employment tax. But when to get an S corp is a big deal. Just don't get an S corp. A lot of people, you'll go talk to an attorney, they will create a C corp for you. One of the worst things you can do. Go get a single member LLC where you are the only owner. Don't get your spouse involved, like I said before. You're gonna have to file a partnership tax return and then run your business like that. As you start making more money, then work with the CPA to see if it makes sense to convert to an S corporation. And if you start making 50, 60, 70 grand, it's worth it. It's worth what you pay your CPA and to do tax planning, because it can save you $10,000, $20,000. People have saved $200,000 in self-employment tax, depending on how much income they make. So understand that. The other question I saw was being a real estate professional and doing wholesaling or being an agent is one of the best things that can happen in your household from tax saving strategy. Someone's asking me, how does all this real estate professional status comes into play when you're a wholesaler or a real estate agent or a flipper? Same concept. If a household, if you're married and one spouse is in full-time real estate, or you're not married, you're single, but you do real estate full-time, then you don't have any limitation on how much tax. If you have W-2 income, you can wipe out your W-2 income up to $300,000. If you have business income, there's no income limitation. You make $1 million by wholesaling properties, this is $1 million, just federal tax. You can wipe out entire for $300,000 by buying real estate and investing in the right kind of assets that we discussed before. So rep status, that's how rep status works. You can really help your family if you're doing wholesaling, if you're getting involved in real estate as a wholesaler or any other even rental properties. You can help your household save a lot of taxes. What people like this is what people like when I show them this. This is how you make your career decision sometimes. And when I say career decision, because sometimes, my spouses will say, I'm just doing real estate. I'm not actually not making money. I'm not getting a respect I need at home because I don't have a job. That's not true. Show them this analysis and they'll probably not think like that. But this person, let's say, okay, I'm just gonna give you a quick example here. I'm gonna remove, let's say we have a husband or one of the spouses make $1,000 a year, very normal. And then let's see what happens. How much you're paying in taxes. $100,000 when you go file your taxes. You know what I'm going to put? Make it simple. I'm going to put $600,000 so it's not confusing. I'm going to put $600,000 in W2, just W2, not a business income. When you do so, look at what happens, how much tax you're going to pay, right? And how your involvement in real estate is going to help. If you go to, and I'm going to answer other questions as well. Let me finish this. So if you go in here, how much tax you're going to owe? You're going to owe almost $170,000. This person is going to owe federal and state taxes in the court $170,000. Now, let's say one of the spouses is a household, a housewife or a household spouse, and then you want to change your career, you want to get involved in real estate, buy a bunch of rental properties, not even wholesale. Go buy a long-term rental property. I want to show you something here. Let's say you go buy RV park for let's say a mobile home park for $1.9 million because you guys have a lot of money, which is, again, remember 1.9 is not a cash payment, guys. This is just a, you have to find a down payment for this, maybe 20%, maybe $200,000. And if you're making $800,000, $600,000, you probably have $200,000 saved up to do your real estate investment or to take a loan or do whatever it is, okay? All I'm telling you is, look at this spouse, this is the spouse's argument. You're in 39% tax bracket, meaning this spouse, when she's getting involved in real estate, if she were to go out and not get it, this is how much she's making. This is my point. She's making $277,000 of W2 income by getting involved in real estate because she's saving she's saving husband $166,000 net of tax income. Meaning the spouse is saving, you guys are wiping out your entire taxable income and saving $160,000 in taxes. That is equivalent of this spouse who is involved in real estate actually going and working and making $277,000 W2 income. So that's where the career change comes into play. Would you rather make $30,000, be a teacher, and get humiliated like our teachers get humiliated, unfortunately, or go invest in your own real estate, save your husband $300,000, you almost sound like you're making $300,000 while building your portfolio of real estate? Remember, this is just 1 year tax savings. What you're getting from real estate is I haven't even accounted for that. You guys are making a lot of money from appreciation, cash flow, and a lot of other things. That's not even accounted for. That's how you make your decision on if you want to do, what do you want to do in real estate. The question is, I'm about to get my license and I'm trying to learn everything because I only want to work for a broker and start my own business. That's the best thing you can do. Once you have business, that's how our tax system works, unfortunately. I just told you, hey, you can only offset up to $600,000 of a W2 income. Once you open up a business, you make $500 million, you can wipe out entire $500 million with real estate. That's what all the rich people do. That's how law is devised. Our law, unfortunately, favors more of the rich people, and then the W2 employees cannot wipe out their income. They have to pay taxes, but rich people can wipe out the entire income. So I like the idea of what you just said. You want to get your license and open your broker. Once you open your own broker, you become your own brokerage. Even when you get your own license, always make sure you understand the tax implication of getting the right entities. That's what I was talking about earlier, right? When you go and open up your business, make sure you get a S corporations, talk to your advisor on when it's right for you. You can always repurpose your S corporation and convert this to a brokerage and have your agents work under you. Again, we're not going to go there. You probably need to have a detailed conversation to come up with the plan, but that's how you're going to do it. What else we got? Do you have any other questions? I saw a bunch of questions I already answered, so I haven't answered those questions particularly. But is there anything else you guys want to know before if we have, I think, I don't know, maybe, 7-8 minutes left. I'll go ahead and show you guys a few other things, what you could possibly do. And maybe we'll talk about this HRA. Anyone can do this. It sounds complicated, guys. If this goes over your head, please go ahead and watch a video on YouTube, and we have a YouTube video and explain the exact same thing. But I guess most people don't understand. So everyone understands that when you have a medical expense, it's a personal expense. You can't do anything with it. There's something called itemized deduction. You can deduct your medical expense if it's more than 7.5% of your AGI. But this taxpayer, this AGI, he has a $600,000 AGI. You have $60,000 or more, or $70,000 or more of income, a lot more before you can even deduct it. The way around you can save taxes is a new thing. It's a relatively new tax saving strategy. Is this in any business you own? Doesn't matter if it's a rental,
partnership with other partners, even your sole proprietor or single member LLC, or your C Corp. S Corp is a little complicated. You have to have another single member LLC below that, but you can do it. What I'm saying is, once you figure out how to do it, all I'm saying is you pay your spouse, have her open up a business, co-pays, and you have a kid, and newborn babies, all those things. $22,000. This guy is already saving how much? Almost $9,000 in taxes of the $22,000 because he was trying to plan to write that out. That's extra $9,000 that you'd never get by spending expenses on your health. How can you structure that? I'll just read this. It looks complicated, but it's not. But I'll just go through the steps and we'll stop after this, okay? Here are the rules. You can read this. You can watch this later on. Your spouse purchases his or her own health insurance plan in the spouse's name to cover entire family, including you as employer will reimburse your spouse for the premiums or anything else, okay, expenses. Now, there are some rules you have to follow to do so. There's no limit on how much you can reimburse. So, but remember, if spouse and you hire your spouse and she does nothing and you give reimburse to $50,000, IRS is not gonna like that. So she need to have some kind of employment contract with you. To qualify, your business must have only one employee. That is why, you're going to establish you have a sole proprietorship. You're probably not going to have any employee, right? This is where you really plan for your taxes. You're a real estate agent, establish a property management company, establish another businesses where you can hire your spouse on that sole proprietorship, and she can do this. Okay, you're going to have to work with your advisor to come up with those strategies. But once you hire them to document the employment documentation, contracts, and there's a time sheet and everything, and reimburse all the costs. You come with a policy, say I reimburse every single month, or as soon as you incur, send me a receipt, you reimburse. That's all. It's not taxable to the employee, which is your spouse. It's a business expense for your business. You get to deduct $22,000 in tax bracket. You get same lot of taxes. That's what the reimbursement policies are. Okay, it's complicated. Not everyone can do this unless you understand how this works. Sometimes it might not be worth it, depending on how much money you're making. If you're in lower tax bracket, do you want to go through all this hassle and do this? No, probably not. So please understand your tax bracket. If it is worth it, how much money you're making. Understand all of those things. And that's what I'm saying. And look at this. Let's say this taxpayer went to tax planning, bought a real estate we talked about, and actually with real estate, tax savings is only $4,000. And if you talk about effective tax rate, it's only how much? It's only $600 for that $22,000 tax savings. But if you don't buy real estate, we discussed before, and you're looking at the marginal tax rate, tax savings, it can be $9,000. So that's what I'm saying. It's tax savings is extremely customized for each client. So we cannot just give you a blank advice here, right? You do need to work with your advisor to come up with these numbers, if it makes sense or not. Good news is that next year, when this goes live, you can probably do this on your own on your software and web-based application. This year, unfortunately, you're gonna have to learn with your own CPAs or us and whoever you choose to work with. Okay, I know I said a lot of things. I will stop right now. You can go and rewatch this. It's live on Facebook, and if you email us, we'll give you this recording if needed. We'll put this in YouTube as well. There are a bunch of other videos on our YouTube. We are trying to produce like 100 videos by the end of the year. If you're not following us on social media, follow us. You don't have to work with us. People pay us so they can get those videos. You just follow us on social media. You can just get those videos. You will not go through these files and not go through your specific situation, but you still get this kind of valuable information so you can implement this on your own or with your CPAs if you choose to work with them. So as I said before, you can reach out to us on our website, investorfriendlycpa.com. You can Google us. You can email us, Julie and me, email address. I think we've given it before. If not, I'll give it here. Oh, Julie has given some videos there on the chat. She has also given us an email address for info. She can also give Julie, if you can give your email, they can more than happy to reach out to her. Julie's our director at the firm. She really helps us put us together. And that's all, guys. I know these calls always are very complicated because it is complicated, but we try to give this free information now so people have opportunity on their own. If you don't think you can implement on their own, this is also help us get new clients. So you can reach out to us to our form up there, which we have shared. And Julie will, we have a very smooth onboarding process. You'll be reached out, you'll schedule a call with Julie, you'll also talk to me to probably if needed, and then we'll help you out. Other than that, guys, I have nothing else. I really appreciate everyone joining Friday afternoon. Enjoy your weekend. If you have any questions, my offer is any of those emails you see, if you email any questions, I'll answer them. Just because you guys have joined the webinar, even though we're not engaged, guys, give any kind of questions you got. If it doesn't take me more than 15 minutes to do my research or give you information, I'll answer them. If it takes more than 1 hour, obviously, I'm not going to answer them. I'm going to say we got to get engaged because it's a resource we have to implement. but I'll answer them if you reach out, and if you simple questions, I'll answer them. So with that thought, Julie, thank you for putting this together. Everyone, thank you again. Really appreciate your learning this. If you have any feedback, please reach out. We'll be more than happy to implement those and help you guys if you have any more questions. Thank you. I'm going to end this webinar now. Everyone, bye-bye.